While this is one of the most basic provision in income tax, but still this is also one of the most important principle. So let us spend a few minutes on understanding this. The beneficial provision of the treaty or the act are applicable. Now, in any non-resident situation, what is going to happen is that this non-resident might be a resident of a particular country. Let's take UK for example, right? When he gets income from India, there is always a treaty between these two countries, right? There could also be a situation where this person might be a resident of a country, let's say Cayman Island, with whom India does not have a treaty, right? So the question which comes up is, in case where there is no treaty, let's say Cayman, and in case where there is a treaty, what provision should be looked at? The need for this arises because in the Act, there is a definition of royalty and FTS. In the treaty, there is also a definition of royalty and FTS. So from a non-resident perspective, is it compulsory for him to claim the provision of the Act? Or is it compulsory for him to opt for the provision of treaty? If there is one, what will happen if there is no treaty? Let us understand that. So the applicable provisions can be divided into two cases. One where there is a treaty, and obviously the second where there is no treaty. If there is a treaty, then the provision of Act or the treaty, whichever are more beneficial, shall apply to the recipient, right? If the Act says that the tax rate has to be 15%, but the treaty says that the tax rate is to be 10%, since the treaty is more beneficial, he can opt for the provision of the treaty. On the contrary, if the treaty would have said the rate is 15%, but the Act says the rate is 10%, you can opt for the provision of the Act. The second way in which the treaty or the Act may be beneficial could be that the Act may actually provide that a particular form of payment is royalty or FTS and is therefore taxable in India. But the treaty between the two countries can provide that this payment is not taxable in India, right? So the benefit could not be only be in the form of a reduced tax, but what is known as a reduced scope of tax. Scope of what is taxable and what is not taxable. So out of the Act or the treaty, whichever one is more beneficial is what is applicable. If there is no treaty that India has with the country of which the non-resident recipient is a resident, in that case, the only choice that you have is that the provision of the Act, the Income Tax Act 1961, are applicable.